In 1980, you could have put $10,000 into a boring index fund and then completely forgotten about it. Today, that account would be worth about $1.9 million. No stock picking, no genius, just one fund and 4 decades of doing nothing. By the end of this video, you'll understand exactly how boring quietly beat almost every professional on Wall Street. Here's what makes this wild. An index fund isn't a clever bet. It's the opposite. It just buys a little of every big company in America and holds. No skill required. And yet that lazy strategy turned 10 grand into nearly $2 million. This isn't a story about a hot tip. It's a story about the single most reliable wealth machine ever built, and why almost nobody uses it correctly. First, the numbers. The setup. In January 1980, the S&P 500 sat at about 108 points. You drop in $10,000 and reinvest every dividend. That's it. You never trade again. The payoff. Today the index is near 5,950, about a 55x jump on price alone. But here's the part most people miss. Dividends. Reinvested, they account for roughly 40% of the total return. Add them in, and your $10,000 becomes about $1.9 million. That's a 12.1% annualized return every year for 46 years. And it did that through chaos. Black Monday in 1987, the dot-com crash, 2008, the COVID crash. Every single time, it fell, and every single time, it came back and made new highs. The boring fund didn't avoid the storms. It just outlasted them. The dirty secret of Wall Street. Here's what the finance industry doesn't advertise. Most professional, actively managed funds, run by experts charging high fees, fail to beat a simple index fund over the long run. The majority underperform the very benchmark they're trying to beat. You're paying a premium for worse results. Why? 2 reasons. Fees quietly eat your returns year after year. And almost nobody can consistently time the market or pick winners, not even the pros. The index doesn't try to be clever. It just owns everything and rides the long-term growth of the entire economy. Clever loses to consistent. So why doesn't everyone just do this? Because it's emotionally brutal to do nothing. When the market crashes 40%, every instinct screams sell. That's loss aversion. Loss is hurt about twice as much as gains feel good. The people who got rich off index funds had to sit through terrifying drops and not flinch. There's also the boredom problem. Buy one fund and wait 40 years feels too simple to be powerful. So people tinker. They chase hot stocks, jump in and out, and quietly underperform the boring fund they abandoned. And there's the "I'll start later" trap. Every year you wait, you lose the most valuable thing compounding has: time. Don't take my word for it. Take Warren Buffett's. One of the greatest investors alive has repeatedly said that for most people, the smartest move is a low-cost S&P 500 index fund. He even made a famous $1 million bet that an index fund would beat a basket of hand-picked hedge funds over 10 years. He won. The index crushed them. Verify. Buffett 2007 to 2017 hedge fund bet. Confirm he won, and the margin. When the best stock picker in history tells you to stop trying to pick stocks, that's worth hearing. Before we get to what you should do, you need to see the silent killer that destroys most people's returns: fees. They sound tiny, and they're anything but. Imagine 2 funds that both earn 10% a year. One charges 0.05%, a basic index fund. The other charges 1%, a typical managed fund. That difference feels like a rounding error, right? Watch what it does over 40 years on a $10,000 investment. The low-cost fund grows to roughly $440,000. The 1% fund grows to about $300,000. That seemingly trivial 0.95% gap quietly ate around $140,000, more than 10 times your original investment, and handed it to the fund company. You did nothing wrong. You just paid a toll every single year on your entire balance, forever. This is why the index fund's boring superpower isn't only that it matches the market, it's that it does so for almost nothing. When you stop paying someone 1% to underperform, you keep that money and let it compound for you instead of for them. Over a lifetime, the fee you choose can matter as much as the return you earn. Low fees aren't a detail. They're a strategy. And there's a second hidden cost most people never count: taxes from constant trading. Every time an active fund buys and sells, it can trigger taxable events that nibble at your returns. An index fund barely trades, so it's naturally tax efficient too. Boring wins again, quietly, on two fronts at once. You might be wondering, if the whole market is just sitting in an index, who's actually picking the winners? And won't the index get dragged down by all the bad companies inside it? Here's the elegant part. An index fund is self-cleaning. When a company shrinks or fails, it naturally falls out of the index. When a company grows, it automatically takes up more space. So the index quietly sells the losers and rides the winners, without you lifting a finger and without paying a manager to guess. Your worst-case loss on any single company is 100% of that slice, but your upside on the winners is unlimited. Over time, a handful of massive winners more than pay for all the duds. The math is rigged in your favor. There's another reason it's so hard to beat. For one investor to win by beating the market, another has to lose by the same amount. It's a zero-sum game before fees. Add in the fees and trading costs the active crowd pays, and as a group, they're guaranteed to underperform the index after costs. It's not bad luck. It's arithmetic. The index doesn't win because it's clever. It wins because it refuses to play the expensive game everyone else is losing. So what do you actually do? Move 1. Pick one broad, low-cost index fund. An S&P 500 or total market fund with rock-bottom fees. Boring is the point. Move 2. Automate it. Set up automatic monthly investing so you're buying in good times and bad, and so you never have to decide to invest. Move 3. Then leave it alone. Don't check it daily. Don't sell in crashes. The crashes are the price of admission for the long-term gains. The $1.9 million wasn't earned by being smart. It was earned by not interfering. You can't go back to 1980. But the same machine is running right now. The best time to start was decades ago. The second best time is today. So let's bring it home. $10,000 in an index fund in 1980, dividends reinvested, is worth about $1.9 million today, a 12.1% annual return through every crash with zero stock picking. Boring beat brilliant. Pick one low-cost fund, automate it, and leave it alone. Now I want to hear from you. Are you team index fund, or do you still try to pick stocks? Tell me in the comments. I read every one. If this made boring look a lot better, hit like, subscribe for a new What If breakdown every week, and share it with someone who's still sitting in cash. I'll see you in the next one.